use as much of this session as possible to address questions that you may have. I'm willing to attempt to answer any question, so let it loose. As Sue said, type it into the menu bar on the left, and we will begin taking some of those questions very shortly. I would, however, like to begin by addressing what I'm finding to be the most common question of the day in the used car industry, and that is, holy cow, what's going on out there? What do I do? We are in the midst of, I think, two fairly significant macroeconomic events occurring. One is the fallout, no pun intended, from the Japan crisis, and the second is the soaring gas prices. And to be sure, these two phenomenons are creating a lot of confusion for the car dealer. And the hot wholesale marketplace continues. And the type of question that I'm getting routinely is, should I pay the money that I have to pay for these cars today? Because if you book them out in the retail marketplace, there just isn't enough room or enough spread there to justify buying the car. And yet, some dealers are unsure whether they are still believing perhaps that they should do it under the assumption that these cars might be worth more next month than they're worth today. So even though they don't make sense today, they might make sense tomorrow. Should I buy those cars? Should I hoard those cars? Should I pass those cars? So, I just wanted to give you a little bit of my perspective on this issue. And I think that, it really begins with an understanding of what we are as car dealers. And the question is whether we're speculators or retailers. And, I understand that the nature of the car dealer is to be opportunistic and even sometimes speculative. And I think that is the nature of the beast, and I think that nature serves the car dealer and the car manager well in most respects. But one area that I think that it doesn't really serve you well in is the area of used car inventory management. What I mean is this. Anybody who thinks they know what's going to happen with the supply chain, anyone who thinks they know what's going to happen with gas prices over the next 30, 60, 90 days, it's just guessing. And unless they're clairvoyant, they're just guessing. And consequently, to do some unnatural acts like buy a lot of cars today that don't make sense is betting that the chips are going to fall in a certain way in the near future. And guess what? If they do fall that way, you're a big winner. But let's face it, you're still a speculator. And if the chips don't fall the direction that you're betting in, you're a big loser. And the real question that we have to ask ourselves as car dealers is, are we equipped? Are we prepared philosophically, intellectually, financially to be speculators, winners or losers? And I think generally speaking, the answer is that we are not. And consequently, I would really advise all of you to resist the temptation to be speculative. I think that what we have to do is continue to operate our used car departments with a discipline by the metrics, by the numbers. Now, that doesn't mean that there aren't some changes in the marketplace that we have to react to. There certainly are. But I guess what I'd like to propose is that we sort of keep this car right in the middle of the road, realizing that the road might be taking a turn that is a little bit unfamiliar to us and somewhat uncomfortable, and that turn being, higher prices than we think, are otherwise justified to pay. So, we might have to go in a direction that is unfamiliar and uncomfortable to us, but nevertheless, I'd like to keep the car in the middle of that road, which means that I think that there are going to be some instances where you do need to pay more money for these cars than you think you should, but they should be the right cars. And what do we mean by the right cars? They should be the cars that basically possess two important characteristics. One is a good eye appeal, because no matter what the internet or market does, there'll always be an emotional aspect of buying a car. And I think the first criteria for buying a car for tall money is that it's got good emotional appeal. And the second important characteristic is that it has favorable market day supply. Its supply-demand dynamic is favorable to you. So I think that when you find cars that possess those two characteristics, those are the cars that I think you can justify paying up for. If they don't have those, I would resist the temptation to pay up, even if people around you are willing to pay up for those vehicles. I also think that we are in some very extraordinary circumstances in this market, and as such, I think that it really perhaps justifies us making some adjustments to our normal pay or play plan. I said play, not pay. Play plan. What do I mean by that? Well, you know, if you're a quarterback and you have a certain position in the field, you bring your team to the line of scrimmage and you have called the play that has the highest probability of success given your objectives. But sometimes you look across the line of scrimmage and you see a defense and a formation that's not favorable to your plan. And what will a good quarterback do? They'll call an audible. So using that analogy, I think that when we look into this marketplace, yes, we all like really big gross profits. Yes, we all tend to like retail rates for reconditioning. Yes, we all tend to like, you know, a big pack. But could we not please recognize that the environment that we're dealing in right now today is probably very unfriendly and unfavorable for those traditional plans. And what I mean by this is that if you are a store that has an expectation for a very high average gross profit, a store that charges full retail for reconditioning, a store that puts a very hefty pack on these vehicles, whether you recognize it or not, what you're doing is making an already very difficult situation more burdensome. In other words, you know, anybody who's got the responsibility in your dealership for going out and buying vehicles has got to have sort of a thought in their mind about what they're going to be able to make if they pay what they have to pay. And if that's burdened by those excesses that I just enumerated, chances are that they are going to pass the opportunity to buy some vehicles that they otherwise really should buy. So I guess what I'm doing is we could have a, you know, an honest philosophical debate as to whether you should or shouldn't be packing, or to what extent, or retail rates for reconditioning. But, you know, avoiding the merits of the arguments, even if you are in favor of those things, I think that you should consider a temporary adjustment to your expectations or your practice, given what I consider to be the most difficult buying market that all of us have ever seen. So, you know, if these notions make sense to you, I think that you should be prepared to pay more than you need to pay. I would not hoard cars. I would avoid that temptation of being speculative. I don't think we're equipped to be speculators. We're retailers, and you know, one of the things that I've really come to understand after doing what I've done now for the better part of a decade is that we, you know, we tend to let our speculative and opportunistic tendencies justify actions that, you know, ultimately are not sustainable. So I think that if you avoid the temptations of excess and overreaction and speculation, it may very well mean that you miss some opportunity. You know, if the chips were to fall the way that you would bet and you don't, you know, speculate, it might mean that you know, could have made some profits that you won't make. But it is also equally as likely that you'll avoid some disaster that will incur if you get it wrong. And I spend too much of my time helping dealers dig out of disasters that are very costly, you know, have very significant impacts on a long-term basis to their business. So, you know, again, I would encourage you to take a very reasoned approach to buying and selling cars. You definitely want to be buying and selling cars in today's market. And, you know, the disturbing tendency that I'm seeing on the part of a lot of dealers today feeling the margin compression that you're all feeling is to raise their prices. And I would really encourage you guys not to fall prey to that very serious mistake. I mean, the response that I received from a lot of dealers today is, oh my gosh, I got to raise my price, give myself more room, more left over. And in fact, I think that's probably exactly the wrong thing to do as a tactic to deal with this marketplace. The thinking is, I can't replace the car. Why would I sell it, for anything less? And when you raise your price in this market, I believe that it's like shutting oxygen off to the patient. It's exactly the wrong thing to do, but yet it's the natural reaction of the car dealer today. As counterintuitive as it may seem to you guys, I think if you really want to make more money in this very difficult market where it's hard to buy cars, hard to replace these cars, I think as counterintuitive as it may seem, you ought to really think about reducing your price. That's right, reducing your price. Why would I say that? Because chances are the dealers around you are racing yours, and the way this internet works is if you are willing to take or ask, not take, ask a point less or two for your cars than your competitors' cars, what that internet does is it favors you with not only your share of traffic, but actually a pretty good portion of your competitors' share of traffic. And then once people get to your showroom, then you fight the good battle for gross profit. You don't do it on the internet with your pricing. You do it once the people arrive in your showroom. And we've talked in the past about some tactics to do that. We can talk about them again if anyone would like to. But again, I would encourage you guys not to use your pricing as a response to the very confused high wholesale value, shortage of vehicles in the used car marketplace. Actually, lowering your price is probably the more effective response. And to the extent that anyone thinks that this really doesn't work and can't be done, I had a session with a very interesting dealer this morning, and I want to share with you guys his numbers. He's given me permission to do this, but if anyone thinks that you can't make a ton of money in the used car business today by lowering your price, if anyone thinks that you can't buy used cars for the right money and the right used cars, I have to tell you that you can, and example the fact that you can is a guy by the name of Mark Ray. Mark Ray is one of the owners of a Chrysler, Dodge, Ram dealership in Toledo, Ohio. Now, I'm sure that all of you guys would appreciate the fact that there's nothing particularly easy about a Chrysler ticket today. There's nothing particularly economically attractive about the market of Toledo, Ohio, but yet here's a Chrysler dealer making a lot of money in used cars, selling a lot of used cars, between 120 and 150 used retail a month, on the way to doing 175. And I just want to show you what this looks like when it works. So what you're going to see here is a profile in vAuto of Mark's inventory. And Susan, I'm going to need your help here. His inventory is in 15-day buckets. And what is his price to market successively?
97.
97.
94.
Yep.
90.
Yep.
And 87.
Okay, so you see that he starts out, under the market by 3 points, 97%, and he goes down very rapidly from there. Now, what that pricing profile tells you is that he's getting all of his market, plus he's getting a fairly good share of his competitors' market. And is he worried about not being able to replace these cars? Not really, because he has developed an expertise of acquiring cars that many dealers don't have, and his average cost to market, which for those of you who are not velocity managed dealerships, it's an indication of how right you own your cars, is 81%. That's his average cost to market. And when dealers ask me today, what should my cost to market be, I tell them that if it's much more than 84%, I'm concerned. But even when I say 84%, I fully realize that many good dealers are going to be 85, 86, maybe even 87. I speak to a lot of dealers commonly that are in the low 90s. So here's a guy who's feeding a very hungry machine of turning vehicles with a lot of cars, and he's able to do it extremely cost effectively. And if you look at the average market day supply of his vehicles, what is that, Sue?
67, 68.
7. Average market supply.
Oh, average is 71.
71, which is extraordinarily low. So here's a guy who, has all of the conditions set up right. He's got the right vehicles, purchased for the right money. Yes, even in this very difficult market, he's got it priced right. And why is Mark having the success that he's having? Because let's see how many times he's turning that inventory, Sue. About 14 retail times per year. Is that correct?
14.71.
So about 15 turns roughly. He's turning inventory at a Chrysler store in Toledo, Ohio. So, when dealers tell me I can't buy these cars right, I can't afford to price them the way I need to price them, I can't find the right cars, you want to know something? It is being done. But, it's being done today with a certain strategy. It's being done with a certain skill set that many traditional dealerships don't have. And it's being done, obviously, with some technology and tools that are not commonly shared or understood by all dealers. But, I offer you this example because it, defies logic. It runs contrary to what every dealer thinks, ought to happen or what they can or can't do. It's being done, and it's being done, not in a easy place, nor is it being done with an easy ticket. So, Mark, if you're on the line, I congratulate you for it, and I, take a lot of inspiration and share a lot of inspiration, from being able to demonstrate that this is being done. But in fact, it is. So, hopefully, with some inspiration from guys like Mark and, some understanding that we really have to stick to the numbers, let's run this vehicle down the center of the road, not, too far off to the left and run scared, or too far to the right and, try and be speculators. Let's just keep this thing down the middle. Let's realize that we might miss some opportunity if the chips fall a certain way, but also let's be sure that we don't run the car in the ditch. I think that that's, the reasoned, practical approach, the disciplined approach that is called for, even in a market that throws us a lot of curveballs. So with those preliminary comments, Susan, let me ask you, do you have some questions there?
I do have some that were sent to us prior to the webinar, today's webinar. Comes from Steve Sarna.
Hi, Steve.
He says, I am starting to think that using a scarcity report helps me acquire cars that are in short supply in the market, but I use the same price to market percentages of cars that are abundant in the market. Do you feel if a car is in short supply, we should price them differently?
Well, first of all, and again, Steve, thank you for the question. What Steve is talking about when he talks about the scarcity report is both AutoTrader and Cars.com produce a report for their dealers that show you something very important. It shows you the cars that are being most searched for, most sought after on those sites in your market. And Steve, who also has a very similar type of success to Mark Ray at Groganstown, Steve is attuned to this list, as you should be. Cars.com calls their list, I believe, the CarStar report, and AutoTrader calls it the scarcity report. Two reports that I would encourage every dealer to become intimately familiar with and actually begin to use it in terms of your decision making about what cars you want to put on your lot. You definitely want to try and put cars on your lot that are being most searched for in your market. But the question that Steve asks is, should he price those cars that have high scarcity, high demand based on searches in his market, should he price those cars with the same strategy as the cars that are less scarce or have a higher market day supply in his vAuto system? And the answer, Steve, is yes. You should absolutely price those cars differently. You see, I say that when it comes to pricing a car, the proper strategy is not to price them all high because they happen to be fresh in your inventory, nor is it to price them all low because you're, feeling like if you don't do that, you won't get internet traffic. I think the right approach is to know which cars can and should be priced high and be very patient if you have to drop the car at all, drop it gradually, and which cars on day one you should be very aggressive on pricing, price them in the basement, and be prepared to revisit them very frequently. So, Steve, how is it that you should know which cars are which? Well, again, it's the two-step tactic that I referred to earlier. You have to be able to look at the car with sort of two lenses. The first lens is look at it as merchandise. because it is always going to be an emotional experience for a buyer. And you guys all have good, innate or trained ability as car men and women to look at a car and very quickly assess its emotional appeal. And the second step, once you've done that, to know whether it's one you put up high and drop slow or put in low and drop fast, is the car as not merchandise, but as an investment. And keep in mind, Steve, that your objective is two things. Number one, fast turn and high. Number two, high gross. And how do you most rationally assess the odds of fast turn and high gross of any item in any efficient, rational market? Through the time-tested principles of its supply and its demand. So, Steve, if you look at a car and you look at it with your car guy eyes and say, wow, that's a car, and that particular one happens to have high demand and short supply, then that's a car you put up high, and you could afford to put up high over the market for a period of time, and if you have to drop it gradually. But on the other hand, if you get a car that has low scarcity, low market or high market day supply, and just as an ordinary car, when you look at it from an emotional perspective, that's a car you should be very aggressive with. And put it in low and be prepared to drop it frequently. So my answer to your question, Steve, is yes, a different approach is absolutely called for.
Okay.
Other questions, Susan?
Yes, we have one from Jim Brooks. What dollar amount per car on average do you recommend?
Well, thanks for the question, Jim. A couple thoughts on that. Number one, it probably depends on the brand identity of your used car lot. The answer obviously wouldn't or shouldn't be the same if you're a Mercedes dealer versus a Chevrolet or a Ford dealer. But, I would tell you that what I really like, and if you looked at Mark Gray's inventory at Grogan's Town, I told him this morning his average unit cost, now keep in mind he's a Chrysler dealer, is $13,300. I absolutely think that 13 to 13.5 is the sweet spot for most, dealerships that have a sort of a broad appeal brand. I think in that mid-13. Now, Tommy Gibbs, who many of you are aware of, a very well-respected, industry consultant and trainer, will tell you that no matter what brand franchise you have, push it down, push it down. The lower the average cost of a unit in your inventory, generally speaking, the faster they turn and the less risky they are and the greater return on investment that you achieve. So, I'm definitely in Tommy's camp in that respect, that I like lower price inventory for those reasons. But obviously, depending on the brand identity of your lot, that might vary. But if you just asked me to pick a number, it would be right where Mark Gray is at 13.3. I like that for that type of a franchise.
Next question comes from Robert Levely. What should the cost to market for full-size, low MPG vehicles be in this market and price to market? Well, okay, and that's a great question. And what really disturbs me is most dealers in America don't even know what their cost to market is, and yet you all have one. And what I've come to understand is that, generally speaking, the price at which vehicles will transact in a market are typically in the low 90s. So you tell me, if you're transacting with a price to market in the low 90s and you own your vehicles, in the high 80s, it doesn't matter how many you sell, you can't possibly be satisfied with the result when your spread is that little. So if you start with the assumption that most cars will transact with a price to market in the low 90s, I'm thinking that you need to own your vehicles, somewhere in the low 80s or mid 80s at the very highest. So, if you look at your inventory as a whole, I think that today, you should be very concerned if your cost to market of your inventory is much more than 84%. Now, there are going to be certain vehicles, like the one that was referenced in the question, that might be the exception. It's the high fuel efficiency vehicle. And if your average is going to be 84, that suggests that you have the leeway to price some of them at 88. And those would be the vehicles that you probably do and should have to pay up for.
But if that's the case, you should also have a fair amount, like Mark Ray at Grogan's Town, that that you can put in for high 70s. And when it all washes out, evens out, you really do want to be in that 84% range if you can. And let me assure you guys something, that every single percentage point of cost to market has a very significant effect on your dealership's bottom line. I mean, we can talk about, the difference between 84 and 85% as if, what's really the difference? It's just 1 point. Let me tell you something, 1 point against the total value of your entire inventory is one heck of a lot of money. So, this is a very important issue and one that many dealers are not tuned into today, but, you got to be very cautious about it. And I also want to point out to you that, there are 3 components to your cost to market. One is what you paid to acquire the car. Number 2 is what you spent to recondition and certify the car. Number 3 is your pack. And, if you have a higher than expected or higher than reasonable cost to market, the problem or the culprit could be in any one or combination of those 3 buckets. Next question, Susan.
Next question comes from Jim Flannery and/or Bradley Kidd at Rust Arrow. There is not an auction venue that I know of that you can acquire cars in those metrics. They must be mostly trades.
Well, okay. To be fair to you guys, and I asked Mark Ray of Grogan's Town the same question this morning when I saw his total average cost to market 81%. I said, Mark, where are you getting those cars? And he did say to me, he said, Dale, that a lot of these are trade-ins. But he told me, interestingly, that a lot of them are trade-ins on used cars, not new cars, which I thought was kind of interesting. So to be sure, I mean, let's not have any doubt about this. The best place to acquire a good used car is at your front door on trade. And if you all agree with that, and I think you should and would, then I have to ask you guys this question, and that is, are you applying all the proper discipline in the world to your appraisal process and your appraisal review? We could afford maybe to be a little bit laxed on the appraisal process, when there was an abundance of cars to be purchased, elsewhere or even on the curb. But today, it's so tight that, honest to God, every opportunity where a customer brings you a car should be viewed as one of the most important opportunities of the day at the dealership. You guys should make sure that you put every single bit of discipline and effort against getting that car, and also reviewing appraisals from the past 60 days, because it's entirely possible that vehicles that you looked at 30, 45, 60 days ago, some of them, the fuel-efficient ones, could be worth as much or more today. And there should be a lot of daily review going on in the dealership to go back and, harvest and review all those past appraisals, as well as, a lot of attention on the current ones happening in the dealership. But I want you guys to understand something. We all have this perception that the used car market is going up and up and up and up. But don't be fooled. Do not allow that perception to have you believe that used cars, are not depreciating assets. They are still depreciating assets. And you want to know how come I know this? Because, with the ability to look at, 3,500 dealerships, almost every single one of them have escalating cost to markets as their vehicles age. So if the vehicles weren't depreciating, dealerships' cost to markets would be going down in the older age buckets, but they're not. They're going up, which tells you that the market value of these vehicles, the retail market value of these vehicles, is coming down. So do not believe for a moment, even though it might be true on a limited exception basis, that some cars might actually be worth more in successive weeks currently. Do not be fooled to believe that your used vehicle inventory is not depreciating you. I promise it is depreciating on you. And one final thought to this question, you say you can't buy cars right at the auction. You can buy cars right at the auction. Is it difficult to do? Yes, more difficult than ever. But I have to tell you something. I do this analysis every day with dealers where we find hot cars in the market, and we go and we book them out and to see what we could pay for them, and we see what some of them have gone through at the auction, and it can be done, and there are guys around the country that are doing it. But unfortunately, at the current time, it takes a lot of effort, it takes a lot of skills, and it takes a lot of technology. But it is being done, and I can put you guys in touch with dealers that are doing it, but it's hard to do for sure.
The next question comes from Amy Benton.
Amy Benton, hey Amy, how are you?
She asks, what are your thoughts on having a 60 days and out policy on aging inventory in the current market we are in?
Let me tell you, Amy, I would say that you should have a 45-day and out, but I'll take the 60. There's absolutely no future in selling aged used vehicles. You have to buy and sell vehicles in today's market, because when you're not buying and selling vehicles in today's market, you're going to catch yourself. It's going to bite you. It's going to come back and punish you. Now, sure. Listen, if cars, in mass are going to be worth more money 30 days from now, and I don't believe they will, but if they are, and it's not impossible, then, if you had a 90-day policy, you'd look like a winner. You'd look like the smartest gal on the face of the earth for having done that. But I want to tell you something. That suggests that, if you think that way, that suggests that you're being speculative, and you better be prepared to lose that bet as well as you're prepared to win it. So, yeah, 60 days and out, you bet. And if you can get it down to 45 days, as many, velocity dealers are doing today, all the more profit you're going to have. You cannot make money hanging on to cars.
Okay, next question comes from Carrie Donovan. Hey, Carrie.
Hey, Carrie. There's one of those guys who knows how to buy cars at the auction for the right money.
His question is it time we add hedge fund manager along with commodities trader to our list of job titles? What are you, hold on, you have more. What are you seeing in the best operated stores on look-to-book of trade-ins?
Okay. You want to know something, that part of Carrie's question is tongue-in-cheek, but honest to God, folks, we are not hedge fund managers. We're not financed as hedge fund managers are. We're not evaluated as hedge fund managers are. And, as good of tools as we have out there today, we're not equipped like they are. So, good point. Carrie asked the question, what's a good look to book? I just got done saying to you, if there's ever a time in our dealership to put, super maximum attention on our appraisal performance, it's now. So Carrie asked the question, what is a good look to book? Well, you want to know something, Carrie, that question is not quite that simple, because, I could go to work for you, Carrie, and I could promise you 100% that I will have a 100% look to book. I could do that. Now, do you want me to come to work for you? No, because you know what I'm going to do. I'm going to give every customer $1 million for their trade, but I'll acquire 100% of them. Here's the real question that you have to ask. You have to say, manager by manager, what is the win rate, which is what Carrie calls look to book? What is the win rate of our appraisals versus weighed against how heavy we're stepping into the trades? So, what should that look like? Well, I've come to understand that too will vary a bit based on the market, based on the time of the year, based on the type of franchise that you have, because you want to know something, if you've got a hot franchise, it gives you more leverage with the consumer on their trade than if you have a sort of a colder ticket. So there are, there definitely is some variables here. So it's difficult to put a stake in the ground and say this is it, but if I had to be forced to do that, I would say that a dealership is doing a darn good job if they are getting in the high 30% of their trades, and I realize that some of you are doing more than that. You're in the 40s and maybe in the low 50s, but I think that if you're doing, in the high 30s, offset with the cost to market in the high 70s, I think you're doing extremely well. But I'm less impressed if you're getting 50% of your trades and your cost to market on appraisal, not to the front line, but on appraisal, if your cost to market, is in the, high 80s or low 90s, I'm less impressed, even though you've got a 50% look-to-book ratio. So, we have to think about the answer to that question in terms of a balance between the win rate and how heavily we step into these. But I think that, if you're able to get 37, 38, 39, 40%, and you're able to do that with an acquisition cost to market in the high 70s or very, very low 80s, I think you're doing a really good job.
Next question comes from Rachel Smith. How did Mark Store achieve such low cost to market? Is it influenced by low packs or service markups?
Yeah, great question. I'm trying to think, Mark, if I asked you that question, it did occur to me to ask you. I mean, one of the things that Mark did tell me that he is getting a lot of it on trades versus buying the cars at the auction. And listen, one of the benefits of a velocity mindset of turning cars 14 times is that you are going to get more than your share of trade-in. So, it's the old story, to a certain extent, success begets success. But to answer your question to the extent that I can, and maybe, Mark, you might want to type in the question box if you could supplement this answer, but I know he's getting a lot of it on trades. I don't suspect that he is putting very ridiculous packs, if any, on his vehicles, nor do I suspect that he's taking great liberties in a service department in terms of what he charges the used car department, but I don't know that for sure. So, Mark, if you would be so kind as to help us fill in some of those blanks, I'd appreciate it. And Sue, if you see that come in, let me know, and we'll come back to that question.
Okay. Next question comes from Kevin McDonald. With most of the popular hybrids being foreign vehicles and with foreign product becoming more and more scarce, plus with rising gas prices, would holding a higher price longer than usual be a better strategy, as wholesale prices will only increase once gas grosses of $4 a gallon on average? Or once gas crosses $4 a gallon.
Okay, and let's just be clear. We think gas average is going to cross $4 a gallon, but how much are you willing to bet on it? So let's just be a little bit careful about some of those underlying assumptions. I've been around long enough to know that sometimes when you think something's going to happen, it doesn't happen. But to answer your question specifically, Kevin, yes, if it is a car that has positive characteristics in terms of its supply and its demand, which I would expect a hybrid fuel-efficient vehicle to do. I would expect it to have a low market day supply, but I wouldn't assume it. If it did have a low market day supply and the car had any sort of decent, sort of visual, emotional appeal to it, then yeah, that would be that type of car that I would put up there high and be much more patient with and drop it more gradually. So that's exactly, the scenario where you should price them high. But I have to tell you that the approach that concerns me is that, I get more and more dealers of late feeling the margin compression to say, well, I'll give all my cars 30 days higher than I would like to, or I'll drop them more slowly than I normally would. Well, okay, that's not right, because not all those cars deserve the same chance or the same amount of chance. And the real key to this business is knowing which cars do and which cars don't. And that same sort of principle goes to when you decide, what to buy and how much to pay for the vehicles. Some cars yes, some cars no. Your ability to know which ones are which is the key.
Okay, so Mark Ray came back and replied, the use of the trade-in market has helped acquire trades for what they are worth instead of overpaying to put a new car deal together. And he has another comment here. He says that I am paying door rate in service $82 and am putting $300 on every car my buyer purchases at the auction.
Oh my gosh, Mark did tell me, and okay, so let me just elaborate on a little bit what he told you. So the part that's very clear is he told you that he's charging door rate $82 an hour, so he's charging full retail, and he's putting a reasonable pack on his car at $300. I would consider that a reasonable pack. I spoke with a dealer yesterday who's putting $1,500 pack on his cars. And I said, oh my God, do you know what you're doing to your buyer? Your poor buyer has got to be the most frustrated guy in town, because he's got to be thinking about what he's going to market these cars for. And he's got a $1,500 pack plus door rate reconditioning. You're killing the guy, please. But, with a $300 pack, which is reasonable, and okay, a door rate of $82, let me tell you, $82 is a pretty reasonable door rate in today's environment. That's okay. But the most important thing that Mark told me and he just referenced is this. And I got to tell you, listen to this carefully. Auto Trader has a product called Trade-in Marketplace. And I'm not here to push Auto Trader's products. I will call it as it is if I think it's good or it's bad. But, you know, a lot of dealers bought Auto Trader's Trade-in Marketplace, in my opinion, on the wrong value proposition. And it was probably sold, quite frankly, initially on the wrong value proposition. It was sold initially on the basis that if you sign up for this product, you know, a lot of people are going to be going on Auto Trader's website and your website, you know, and selling you their car. Well, I think it's going to take a really long time before the market understands, you know, that Trade-in Marketplace does that. But the right value proposition, and this is really key, this is what Mark does. This is probably the single thing he does that gets him the low cost of acquisition, is his process of appraising a vehicle. Standard operating process is to take every customer to a computer screen and make them answer, you know, the multitude of questions that have to be answered about your car, Mr. Customer. You know, do you have all the key fobs? Do you have this? Do you have that? I mean, you go through this very sort of arduous question-answer process, and when you get done with it, you know what Trade-in Marketplace does? It produces a firm offer to the customer. Now, think about what he's done there. The fact of taking the customer through this you know, question process, the process itself devalues the car in the mind of the consumer, because when they have to answer truthful questions about their car's condition and past experience, just that process devalues it in the customer's mind in a very professional way. And then when that Trade-in Marketplace spits out a number, no matter what the number is, you and I know that the first number is always going to be objectionable, you know, just by default to a customer. The customer says, oh, no, I couldn't sell my car for that. And then what Mark's people will do is they'll say, oh, wait a minute, you know, that's just Trade-in Marketplaces. You know, that's just one objective opinion of someone who's going to write a check. We're also going to take a look at your car. So what that process has done is it's devalued the car in the mind of the consumer, and it has really opened the customer with a number that, even if it is low, you know, Mark's dealership doesn't own the responsibility for it. So it's one heck of a smart way to appraise cars, and I have to tell you that, in my opinion, today is the highest value of that Trade-in Marketplace product. And I will also tell you, if I'm a dealership today, that is the absolute standard operating procedure that I would use for every single customer. It just makes all the sense in the world. And, you know, when you do it religiously like that, you get cars in under the money. But it's very difficult for a lot of dealerships to do it because, you know, we all do appraisals our own way. We do window appraisals, we do flyby appraisals. But I got to tell you, if you want to shortcut the appraisal process, okay. But be prepared that you're probably going to pay more than you need to ultimately to acquire that trade. Thanks for that clarification, Mark.
Okay, and we have the same question from two of our attendees here, from Michael Spiegel and Jerry Powers. What is an acceptable used car pack range?
Well, you know, again, let's just examine this for a moment. You know, a pack is a tax. A pack is a tax. It's an owner's tax on the transaction. And you know what? Taxes, I guess, don't seem so bad if we can pass them on. And we used to be able to pass on the pack or the tax to the customer. So you know what? Everybody in the dealership won. Today, however, we all understand in this very price-sensitive market that packs don't get passed on to customers as readily and as often and as much as they once did. So consequently, we get left holding the bag on this pack, on this tax. And what do we all know that tax does to commerce? If you tax the heck out of a transaction, what would you expect to happen to the volume of that transaction? You would expect it to go down. So when we tax, you know, or pack vehicles, we're taxing them. When we're not able to pass them on, it slows down the transactions. So let's just understand that first from a theoretical basis. Then to address the question, you know, in its specifics, what is the right pack? Well, you know, I think it has something to do with the environment. If you're dealing with a highly margin compressed environment as we are today, where there's a small spread between what you have to pay for the vehicle and what the market will allow you to charge, I think you need to be very, very conservative on your pack. I personally think that about $300 is about all you can get away with today. But, you know, who knows? There definitely were times in the past when you could get away with a lot more, and maybe there'll be times in the future, although I'm not confident about it, but there might be times in the future, you know, when there's more forgiveness in this used car market that you could jack that pack back up a little bit. But do I ever think it should be, you know, what dealers once did, you know, 8, 9,000, 1,500? I don't think so. And I think if you do that, you recognize what you're doing. You're going to slow down the commerce.
Next question comes from Pat Cassidy. Being a Honda point and with the predictions of no incoming new vehicles, what % of the market would you feel comfortable with for Honda product acquisition? My previous percent was 95 to 100% depending on day supply.
Yeah, you know, if you've got a really good franchise, a really good ticket, and, you know, I think that definitely, you know, justifies having a lot of that product on your used car lot. But, you know, here's the curveball. The curveball is that, you know, that these products are, that the new car product is going to be short. The parts for these cars, new and used, are going to be short. So I think if you're a Honda dealer, I think you better be, you know, looking to supplement your used car lot with other vehicles that fit the brand identity of a Honda dealership that are possibly, and I stress possibly, you know, available at reasonable money. You know, maybe Kias, maybe Hyundais. I mean, these are unbelievably good cars, good quality cars these days. And I'm not saying that those cars are easy to buy, but you want to know something? They might be a little bit easier to buy in this wholesale marketplace than your, you know, very attractive Hondas. So, yeah, I would consider reducing the composition of your lot. Because, listen, you know, all that used car lot is square footage that has been dedicated to a financial return by selling used products. And you want to know something? I don't know of a used car manager in the history of the business that ever got fired for not selling the right mix of products. I know plenty that have gotten fired for not selling the right number or generating the right amount of gross, but I don't know of one that ever got fired for selling the wrong mix. So listen, the road is turning, and I encourage you to keep your vehicle on the road, in the center of the road, but the road is turning in a direction that causes us to head in a different direction, one that's a little bit unfamiliar, maybe a little bit uncomfortable. And for you at a Honda store, you know, or similarly situated stores, I think it means that you better be prepared, you know, to sell some vehicles that are not your, you know, franchise product.
Next question comes from Steve Sarna. With the growth of cars posted on the Internet, when will vAuto, Auto Trader, or Cars, that would be Cars.com, actively do something about removing the cars that are sold or don't exist online, and we are using these comps for our pricing? I have many times picked up the phone and called the dealer that had a car online much cheaper than mine, and to hear the salesman say, we sold that car months ago. Well,
Steve, I want to tell you that sites like Cars.com and Auto Trader, to a certain extent, have to, you know, rely on what dealers send them or what they pull out of their inventory management system. And we all know that there are typically cars, or there are sometimes cars in the inventory management system that, you know, are no longer in inventory. The vast majority of them have recently departed inventory, but there are some dealerships who have such bad, you know, accounting practices that they stay in there a long, long time. And there are some dealerships, I suppose, that purposely do it. Although I think you're giving, you know, dealers too much credit if you think that they're purposely doing it. But I'm sure that happens as well. But Steve, these should be the exceptions, not the rules. And one of the things that vAuto does is that, you know, we watch these cars come off the Internet. And one of the things that we all have to keep in mind is that when cars are sold, well, all cars, most every car is on multiple different Internet sites. And not every site is as responsive as they should be in terms of price updates or taking the cars down when they're sold. So, Steve, when we see a car come off of one site, but we still see it on other sites, we suspect that that car is gone, and we actually prioritize the sites. We know which sites tend to be the most responsive to updates. So in other words, if we see a car come off of a very responsible site like Cars.com or Auto Trader, but linger on, a third-party site like Bubba's Used Cars, we actually consider the car gone. Now, I know that many of you using vAuto have had differing opinions as to whether we should still show those cars in the competitive set, because when they're still out there, even if they're gone off the dealer's lot, but they're still on the internet, it continues to shape the shopper's perception as to what they should pay for the vehicle. So I hope all of you who use vAuto know that you have a setting that you can either exclude those cars that we think are recently sold or show them. If we show them with that gavel icon to give you an indication that we think they're recently sold, but they're still out there. So Steve, I don't know if you're aware of that switch that you can control, but hopefully you are and you're using it. And if you ever see a dealership or notice a pattern of a particular dealership not taking vehicles off, bring that to our attention, and perhaps we can address that in a different way.
Okay, let's do a time check here. We're about 52 minutes into the hour. We still have at least a dozen questions to get through, so we may run long, but know that we'll keep going here.
Yeah, if anyone wants to stay on longer, I'll try and answer all the questions. Thank you.
Okay, from Byron Veit, sometimes when I use the appraisal tool, the market day supply is lower than when it is pulled into inventory. This has happened the same day in some cases. Is this because of the choices on equipment from the appraisal tool to the right-hand rail and inventory pricing?
Exactly. That's one of the most common reasons. You got to be sure that the equipment configuration is lined up exactly the same if you expect the same market day supply. And then another potential reason is sometimes you might set a different radius for the appraisal comparison versus the inventory comparison. So if you make sure that your equipment is lined up exact one-for-one, and you make sure that the mileage radius is lined up for one-for-one, you shouldn't too often see too much of a difference. But everyone should keep in mind that the vAuto system is updated every 10 seconds. So it is possible, within the matter of 20 seconds that something can change, but it ought not to change a whole lot, in a short span of minutes or hours. But it is, even if it's lined up one-for-one, it's still possible that it could change. But if you suspect that something else might be going on there, please bring it to the attention of your performance manager, and we'll look into it immediately.
Okay, next question comes from Melissa Cook. I see that Mark advertises both Trade-in Marketplace and KBB on his website. Do you think this is helping him acquire inventory at better pricing?
I think and I'm reluctant here to speak for Mark. Mark, maybe you want to respond to that, but my sense is that Trade-in Marketplace as an inventory acquisition tool is only going to grow over time, and I do know that Auto Trader has plans to put Trade-in Marketplace on the Kelley Blue Book site, which I think will greatly accelerate it. But as far as Trade-in Marketplace is definitely helping them acquire vehicles at reasonable lower rates than he otherwise would. I'm not sure about KBB. Mark, you might want to give us some input on that.
Okay, from Todd Tift, when you look at the competitive set, where is that data compiled from? Is my thinking correct that it only compares other dealers running vAuto?
No. We we see every vehicle for sale in America on every website. So it is definitely not just confined to vAuto dealers. It's every dealer in the USA with a similar vehicle on the internet.
From Jesse Bishop, how do you feel about buyers within a dealer group but at different stores bidding against each other for the same car?
Well, I guess that that's a pretty good question. That's sort of inefficient, irrational. That's a pretty good question. Suffice it to say, there's a lot of inefficiency in the intra dealership group. One of the stores, and Carrie Donovan from Swope Automotive in Louisville, Kentucky, is on this call. And Carrie, I hope I don't trouble you with this or burden you with this, but Carrie's just one of the smartest guys that I know about rationalizing inventory within his dealership group. So Carrie, this one is yours. But Carrie has devised really a brilliant system of of rationalizing inventory within the group. And too much detail to go into at the time remaining, but I would reach out to Kerry on that question. He could really enlighten you on that, I think.
Okay, and Mark Ray replied back, I tried to replace KBB with TIM, but the manufacturer does not allow me to.
Oh, well, there you have it. It's a manufacturer dictate. But I think what Mark will tell you is that trade-in marketplace is absolutely, the pillar, the centerpiece of his acquisition process, and I might add his low-cost acquisition process.
Okay, a comment from Gary Sanders. Even if you are at 60-day turn and it takes you 5 days in service, 3 days in detail, 1 day to get photos uploaded, you are already close to a 45-day online marketing turn.
Darn right. Darn right. And that's why it better not take you 9 days to do that. I mean, let's be really clear. Let's be really clear that if you are going to be a velocity dealer and you're going to make, tons of money in used cars, as, a Chrysler dealer in Toledo, Ohio is proving to do, you better have a much more efficient reconditioning process. Mark told me on the call this morning that he gets his cars through the shop and to the front line in 3 days or less. And I also want to, share this with you, that we all need to separate this notion of getting a car to the physical front line from getting a car to the virtual front line. If, 3 days, in my opinion, is acceptable on the outside, getting it physically to the front line, but virtually getting it to the front line, it should be done in minutes. Even if the car is bought thousands of miles away at an auction, there are dealerships around the country today, and lots of them, that have that car with a photograph. Might not be the final or the best photograph, but it's got a photograph on the internet with a price, with a description, within minutes of the bell ringing thousands of miles away. And I got to tell you something, that sort of speed and urgency of getting cars to both the physical and virtual front line is the hallmark of a velocity profitable dealership today. And the reconditioning process has got to be addressed as a significant constraint to profitability.
From Bruce Huckfeld, a comment, vehicles are not depreciating anywhere near where they were in the past.
No, they're definitely not depreciating nearly as much as they were in the past. But that doesn't mean they're not depreciating. And I've got 3,500 dealerships showing me that they do. So, I'm not sure exactly what that point is, but, I'm really sort of very, emotional about that, because it is so easy for you guys to think that cars don't depreciate in this environment. I'm here to tell you they do. Okay, not as much, but they still depreciate. So where are you headed hanging on to these cars? Unless you think, unless you're willing to really bet the farm that this world's going to go upside down and depreciating assets are going to become en masse appreciating assets, I would be very careful about, how you think about it.
Okay, from Brian Haggerty, with gas prices predicted to rise and the current large truck SUV market softening along with the market data lagging, how should we value these mid to large SUVs and trucks?
Yeah, I think what's really interesting is that we saw at similar gas prices 3 years ago, we saw much more depreciation in trucks than we see this year. And that's sort of the way the world works whenever you get a trauma. The first time you get a trauma, the effects are much more devastating than when that trauma gets repeated in successive patterns. So, we sort of been through this once before. People are not panicking on these vehicles' values as they once did. But to be sure, there's got to be a relationship between the value of these items and gas prices. The problem, or the question suggests the problem, and that is, to what extent does that relationship exist? And I got to tell you, I don't know. I really can say that I don't know, what is the mathematical relationship, even though I'm sure there's one between each, penny of gas and the value of these vehicles. I just know the relationship exists. But that's all the more reason. The fact that none of us really know that answer is all the more reason why you want to be buying and selling vehicles in today's market. Because, we can see what it is today. In vAuto, you can see what it is today. But tomorrow it could be something very different, and a month from now it's for sure going to be something very different. So, could we not understand that the question suggests the answer? If we don't know the answer to these questions, if we have to ask these questions, all the more reason why we want to buy and sell cars in today's market. That mitigates your risk, treats you like a retailer, not a speculator.
Next question comes from Eric Stamps. How are dealers doing with special finance inventory? Is that a dead issue today?
Well, I happen to be a big believer in the special finance business. I think, unfortunately, more and more people are falling into that category. And, I understand. I'm no expert in special finance, I'll tell you that. I understand that there's been, a lot of problems with funding of these deals, but that seems to be getting better. I would definitely be all about the secondary and special finance business, although I'll give you guys one big warning about that. The rules of engagement of the special finance versus the mainstream used car business could be more different. Basically, they're two different businesses. The only thing in common is that there's a car involved. But, what inventory you buy, the rules by which you use to buy the inventory, how you price it, how you advertise it, how you, handle the client or the customer, everything is different. And where dealers get in trouble is when they try and run what is essentially two different businesses from one lot, with one inventory, with one sales crew, with one acquisition and pricing strategy, one website. It becomes, you don't do a good job or as good of a job on either as you could do to the extent they're separated. Now, not all of you have the luxury of putting a separate lot up, for these cars. I get that, I understand it, but if you don't, try and create as much separation as you can. Different area of the lot, different cars, a dedicated salesperson, dedicated website for those vehicles, dedicated pricing and acquisition strategy. Separate as much as possible. But I would be investing in that business for sure.
From Andrew Walzer, is there a plan to incorporate mileage into your cost to market metric like your V rank on the retail side? If the dealership stocks a high % of low mileage per vehicle vehicles, this cost to market may appear to be high.
That's a really good question, Andrew. It isn't clear to me that mileage isn't already somehow calculated into cost to market. The real question is, cost to market is a fraction, and the numerator is what you own the vehicle for, and the denominator is the average retail asking price of that car. And Andrew, what's not clear to me is whether that denominator isn't a mileage adjusted denominator. So, let me get the answer to that question, and then I can tell you whether it is or it isn't. And my sense is that it is, but I'm not sure. Great question. I'm sorry, I can't be more definitive on that.
Next question comes from Aaron Wallace. If you have a strict 45-day turn policy on Hondas, how do you feel about extending that to 60 days on just Hondas based on what the new car inventory levels over the next few months?
You know what? I don't, what you're basically saying is it okay to slow down my rate of sales and my rate of replacement because I think I'll get more money for the car? Slow it down how much in exchange for how much more money? I mean, do you really know the answer to this? I don't know the answer to it. I don't know who knows the answer to how much every dollar you raise the price of your car to slow down the turn. To what extent will that get you more profit? I guess it depends on what happens tomorrow and the day after that and the day after that. And I got to tell you, I don't know the answers to those questions. I mean, really what you're suggesting is, should I speculate a little bit? Hard for me to say, whether you should speculate a little bit or none. I know what I would do. I would buy and sell today's cars in today's market. It might mean that I'll miss some profit, okay? I'm a big guy. I'm okay with that. But I know it will also mean that I won't get caught long and wrong. And I spend most of my time, unfortunately, helping dealers dig out of being long and wrong. And I got to tell you, it is misery. So, if you want to try and maximize every opportunity you can and be speculative, and it is being speculative, going from 45 to 60. Okay, but understand what you're doing, be prepared for the consequences, and you might win. You might look like the smartest guy in the world for doing it, but I don't know how to manage that way. I don't know how to manage, consistent success in a speculative, with a speculative strategy. I just don't know how to do that.
Okay, next question comes from Jim Claro. What is a guideline for how often prices should be lowered, i.e. weekly, biweekly, or monthly? Should it be different for different types of vehicles?
Well, let's start out with the understanding that the market changes every single day. New cars are coming, old cars are selling, prices are being changed, okay? You're a retailer competing in that environment. So, you answer the question. And I think the right answer is that if that is the game that you've signed up to play, that's the environment that you play in, I would say that the answer is that you should monitor and respond to the market as often as necessary. And that might mean every day on every car. It might mean every day on some cars. It might mean every other day or once a week for other cars. But the point is that if that's the game you signed up for and that's the environment, then I would say that you have to be on guard. You got to monitor, as often as you can and adjust as frequently as necessary.
This next question has a two-parter from Bob Cockerham. Dale, are there any best practices sourcing for used cars in today's market? And he also writes, looking for ideas maybe outside of the auction that you have seen.
Yeah, there's definitely best practices, and by the way, I mean, we run workshops around the country on sourcing because we know what a pain point this is for dealers, and these are no-charge workshops, and even if you're not a vAuto client, you want to attend, let me know, and we'll make that happen. But there are definitely creative things that guys are doing. I mean, we talked already about what Mark Ray at Groganstown is doing with Trade and Marketplace. Kerry Donovan down in Louisville is opening buying centers in strip malls where you can go in and get your car appraised and buy cars, and he's having success doing that. So there are definitely things that guys are doing around the country, and it probably deserves more time than I can dedicate to it right now. We've dedicated a whole workshop to it, so I don't want to shortchange on the answer because it's a really important question. But please feel free to reach out to me, and I'll give you guys my telephone number and my email, and if I can help you or put you in touch with guys who are doing some of these creative things, I'll be happy to do that.
Okay, from Todd Matt, where can you find the scarcity report on AutoTrader?
As an AutoTrader dealer, and I'm sure this is true for Cars.com as well, you can log into the back end of those sites, and I know that the scarcity report can be found there, and if you can't find it, contact me and I'll show it to you, or contact your AutoTrader or Cars.com rep for the CarStar report. But these are really, really important vehicles for you to be aware of.
Okay, next question comes from Jeremy Long. We are currently pacing on 170 used and have only carried around 130 units plus or minus 10. We would like to grow our sales to 200. What would you recommend as the next step for this moderate growth to take place in this hostile time from an inventory standpoint?
Jeremy, first of all, congratulations on your success. That's an outstanding velocity job. And I also really appreciate one word in your question. I think it was moderate growth. You see, I want to tell you guys something, that there's only one justification to put more used cars on your lot to grow your business. Only one. It's not the time of the year or the month of the year. Okay? It's not the fact that you want to sell more cars. It's not the fact that your salespeople tell you need more cars. The only justification to put more cars on your lot is when you earn the right to do that, and when you've earned the right to do that, you'll know it because your turn will be at least 14 turns per year retail. Now, when you are at 14 turns or higher retail per year of used car inventory, unless you're capital or space constrained, you've earned the right to put more cars on your lot. But having said that, let's never confuse the issues of when should I put more cars on my lot with how many. I've seen dealers that have earned the right because they have high enough turn to do it, but then they do it wrong. They say, okay, well, let's go out and buy a truckload or 2 truckloads of cars. That's not the answer. The answer, once you've earned the right, you've gotten your turn up to about 14, is that you very, very moderately, as you used the word, or incrementally, add cars to your inventory to bring your turn back down no lower than 12. If you bought so many cars that your turn went below 12, you put yourself in a disadvantaged situation. So incrementality is truly the path to sustainable growth. Now, if you went out and bought 20 vehicles and the sun happened to shine warmly for a week or two, and you got lucky and sold those 20 cars, you might think, you did absolutely the right thing. So what I'm saying to you is, with my approach, you might miss an opportunity to sell some cars or not sell some cars you otherwise might have sold. But similarly, I'm going to tell you that if you do it by the numbers, prudently, moderately, incrementally, that's the way of doing it, such that you grow intelligently in a sustainable way. But that is the only proper justification. Put more cars on your lot to expand your business, Jeremy. Now, that's one answer. The other answer is that, we could look at putting a different composition, a wider spread of vehicles on your lot. And there's definitely a strategy of doing that, engineering inventory on your lot beyond those which you have already sold. And this, again, is a whole workshop and a whole discipline. I'd be happy to spend time with you individually or with your performance manager. But great question, and there are ways to do it by putting more cars on your lot properly and widening the array of cars, but they've got to match what your market is demanding right now.
Okay, and we have a note from a Michael Hatcher. He's with AutoTrader. He wanted to let Todd and the rest of us know that the scarcity report on AutoTrader.com is not on the dealer site. It is produced monthly and can be provided by your consultant.
All right, I stand corrected. I'm sorry for that misinformation. Thanks for the clarification, Michael.
Next question from Pat Cassidy. At what point do we become the end consumer instead of our customers?
That's a good question. I'm not sure. I don't know. That's a good question. I'm not exactly sure, what's behind that question. But when do we become the end consumer? If you'd allow me to have a smart guy answer, it's when we decide that we want to slow down our turn. To me, we start looking like, owners of cars. We start looking like collectors of cars. We start looking like end users of cars. But that's really not the answer. I don't know. Where's this market headed? I have to tell you something. It is absolutely a challenging market. I will tell you that there are going to be winners and losers. There's never going to get to a point where no one can make any money. There are guys out there who understand the rules of the new game that are, very well equipped to play with those new rules, and they'll win. I mean, a good example of that is, the pressure in the margin is such that it makes 9 out of 10 car guys want to raise their price. You take the 1 out of 10 guys, the really smart guys who say, wait a minute, I'm going to go the other way, I'm going to lower my price, and, do a whole bunch of other things right, they're going to win. So, I mean, it was Charles Darwin, who said the future belongs to not the strongest or the smartest, but the one that is most willing to adapt.
Okay, and we have a comment here from Bob Morris. He says, thanks, Dale. Appreciated the input.
Bob, thank you so much. I appreciate your participation.
And we have just a couple questions left now from Craig Bolowski. I got to believe that Mark's comment to his appraisal process and smart use of information combined with close attention to retail reconditioning practices are at the core of his good cost-to-market metrics.
No question about it. I mean, good cost to market doesn't just happen, and it doesn't just happen by looking harder and farther for cars. Great point, Craig. It really happens through a series of very intelligent, well-executed, disciplines. By the way, Craig Bolowski, I'm so proud of. He's now on the vAuto team. He was the longtime general sales manager at a very high-performing Toyota store in Acton, Massachusetts, Acton Toyota. And Craig just recently made a career change. He's with vAuto, and he's just one of our many tremendous resources. So if Craig can be of assistance to you and advice in any way, he's recently out of the water.
Okay, from Ryan Junick. We use vAuto to merchandise our new cars as well as our used. What is a good new car VDP %, and will there be a way to track our new and merchandising on vAuto in the future?
Yeah, I'm definitely giving more and more thought to working with new cars. I don't have enough formulated to share in any sort of meaningful detail, but I'm getting the question more and more about new cars, and with our relationship with Auto Trader, we've got a lot of access to new car data information that we didn't have before. So the second part of the first part of your question has to do with new car VDPs. I have to tell you, I'm not familiar enough with new car VDPs to give you the right answer on that. I would definitely direct that to your Auto Trader rep or your Cars.com rep if that's who you're doing new cars with. I just don't know. I will tell you this. VDPs, ladies and gentlemen, are the money metric. There is a direct correlation between how many VDPs the store gets and how many used cars it retails. Mark Ray of Groganstown told me this morning that he gets over 10,000 VDPs consistently from Auto Trader, and what I tell dealers every day around the country is that it takes at least 10,000 VDPs to sell at least 100 used retail cars. I don't know too many dealerships, if any, that sell over 100 retail used in a month without generating a minimum of 10,000 VDPs, and there are ways to do it. And I've done webinars on that. You can find them on my website, but suffice it to say, we could not speak enough about the need to have the skills of turning your dealerships into VDP factories that will directly correlate to your used car sales.
Next question comes from John Ruswick. We are currently running with inventory near 60 units and turning 20.79 times per year as of today. The average 18 days in inventory. The answer is not always more inventory, it's turning the inventory. Thanks for the great tool. Also a Chrysler dealer in Michigan.
Oh, congratulations. I mean, that's tremendous. The only thing, that I might be somewhat critical of constructively, and I mean this very constructively, is that, again, unless you're space or capital constrained, when you get 20 turns, and I have seen that happen, and it's a phenomenal job, what I begin to worry about is if you're missing some opportunity. And in theory, you could do one of two things, or in practice, you could do one of two things. You could raise your price, slow the turn, generate some extra gross, or put some additional cars out there. But truthfully, hats off to you with 20 turns. I have seen it happen, but I would encourage you, unless you're subject to space or capital limitations, to think about doing one or the two things I just suggested. Nice work. Thank you.
And our final question comes from Mike Fitzpatrick. Across the vAuto spectrum, what is the average front-end growth?
Don't know the answer to that because it varies considerably from market to market, from month to month, from franchise to franchise. It's all over the board, and I suspect that the average vAuto gross would not be a whole bunch different than the average industry gross, because the notion that higher turn means lower gross is absolutely false. And the reason that the industry has that misperception is that they think because you lower your price, you must be grossing less. But you want to know something, the dealerships who know how to manage with velocity lower their price and often gross more. And you want to know why? Because they use the internet to get the people to their showroom. And then once the people get to their showroom, they're doing things there to hold on to gross that you are giving away on the internet and not seeing customers in exchange for it. So it really, they might be giving away a point or two more than you in their pricing, but they're holding on to several more points likely than you might be in their showroom. So, the future of this business, the present of this business, is not to fight the internet, not to fight your competitors, or not to fight the internet, actually use the internet. And the way you use the internet to get more than your share, to get your competitor's share of traffic, is to price lower, get the people to your showroom, and then once they get to your showroom, now there are practical techniques replacing negotiation with documentation that allows you to sell the car for the asking price or very close to it. And one more comment about a guy like Mark Ray and Kerry Donovan. These guys are negotiating, less than $300, getting down to $200, and in some cases less per deal on a car. Now, those of you who think that you're out there for gross, pricing your cars up high, can one of you guys tell me that you're negotiating as little as $200-300 on average per car? No. So at the end of the day, it's what you're left with, and these guys are just using a much more efficient, smarter strategy to end up with more than the traditional wisdom, of traditionally minded managed dealers.
Okay, those are all of our questions.
Okay, hey, I really want to thank you guys. I know we went long. I'm so inspired by you guys who are out there getting it done. I'm even inspired by you guys who are out there just figuring it out. It's a tough time, and I want to tell you anything I can do, whether I do business with you or not. Sue, if you can put up my cell phone and my email, you guys can call me or email me 24/7, and anything I can do to help you, I'm enormously appreciative for all the support that you guys have given me. So, Susan, is my information up there?
Yes, it is.
Okay. Everybody, have a great day, and please don't hesitate to reach out to me. Thanks so much.